Welcome to TradeSpoon in the Yellow Tunnel. My name is Carpel. I'm CEO and founder of TradeSpoon in the Yellow Tunnel. And today we're going to have a live trading room open to trade stock and options. Welcome to Tradier Hub. I'm glad you guys can make it. For those of you who are new, welcome. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express. Started Yellow Tunnel 5 years ago. We basically have since I worked at Options Express, we built a team of financial engineers that are constantly building new models and signals, and I trade these signals in a live trading room environment. And that's what we're going to see today. Uh, Disclosures are very important. Please read them. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept them in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education and information purposes only. Bob, Thomas, let me know if you guys can hear me. Just type in yes if you can hear me. I want to make sure that the audio actually works good. All right. Bob, Thomas, all good. All right, perfect. Thank you, Bob. Appreciate it. All right, so let's take a look at the current market. We do have Dell announcing earnings. We're going to talk about Nvidia earnings, right? We had Nvidia earnings last week, which we covered. And similar to last May from last year, we had a strong demand for Nvidia calls, and stock has gapped up and continues to rally. It is down today with the market at 2%, but still near all-time highs. So Nvidia has delivered on the earnings, and we have a similar setup in terms of Dell. Announcing earnings today, and we'll see if we can capture the upside or see if there's a downside. Before we jump into Dell and Nvidia earnings, let's just review overall state of the market. Looking at the 10-year yield, we had a pretty sharp rally from the 200-day moving average, and now we reclaim 50-day moving average and above this breakdown of 4.5%. Right, this was an important 4.5 support level. As soon in the beginning of May, once yield dropped after the CPI data, we had a market would make new all-time highs. Now that we have a pretty sharp rebound and we got close to 4.7, 4.63, market did pull back. So let's take a look today. We see value stocks basically dropping below 50-day moving average and approaching April lows, right? Not that far away from April lows. So day one, day two, below 50-day moving average, the trend is trending lower. So I would be concerned about Dow Jones stocks and the value stocks in general and stocks that are sensitive to interest rate. We did have pretty sharp pullback in CRM, and that's contributing to Dow Jones, right? Because CRM, Salesforce announced earnings, missed the earnings, they're down 20%. And you can see Dow Jones is actually underperforming the value stocks. It's very close to the April lows. So we do see weakness in Dow Jones and value stocks in general. And today, even technology stocks are being under pressure, right? So you have XLK dropping below the breakout level, which is a very important level, right? The 211. This is the breakout of February highs. And now we're trading below that on its way to retest 50-day moving average. Let's look at spiders and QQQ and see if there is a general trend in terms of support and resistance levels. Spiders is trading right at the breakout level. So XLK, which has Visas and MasterCard and Microsoft, is below the breakout level, and Spiders is trading right at that level, 523.80. We were as low as 522. So pretty vulnerable setup in terms of Spiders. Let's look at the positioning. We looked at it this morning. Bear with me, I'm using two monitors to make sure we don't have the same issue as last time. So now I'm looking at positioning. Let's look at spiders. So going into Friday, so the screen here shows dealer exposure. And looking at the key level right now is 5. Once it loads, let's see. We'll just give it a second for the spiders to load. Bear with me. Um, so it's taking a little bit longer to load, but once the spiders does load, we do see a pretty large positioning around 520 level. We'll see if that right. So 520 level was the Friday expiration, and the next strike price, if you look at the expiration, is at 510. So there's really no support. If this level doesn't hold 523, 520, the next level would be 510. Um, we do have interest rate sensitive stocks like small caps bouncing off a 50-day moving average. That's bullish for the market. And regional banks also rebounded from the 200-day moving average. Uh, and short term are oversold. We have silver pulling back 2%, and gold miners are up 1.5%. We talked about XLK being under pressure. China is staying above 50-day moving average and 200-day moving average. It's looking at this gap, right, as a main support, 26 level. So all eyes are on interest rates. We do have PC data tomorrow. And today we had GDP revision data that was to the downside, and that's one of the reasons why the interest rates are down. Pending home sales are down, slight uptick in initial claims. So all of that is contributed to kind of a bad news is good for the market because yields are dropping with anticipation that interest rates will eventually be lowered. And going into tomorrow, the main event is PCE index, right? Personal consumption and expenditure. Uh, this is something that PC data is something closely watched by Fed, and that will determine the kind of the fate of interest rates. Are we going higher or are we going lower? Any questions? PC is the main factor, Bob. Yes, I do agree that PC is the main factor. Thank you for commenting, Thomas. Welcome. So in terms of, let's see if the okay, so spiders did load, so we can see that we do have a support at 520, right? If I click on the strike price, this shows you where the positioning is, largest position, about 60,000 Vanna, very large position at 520. So unless we have a really bad PCE data tomorrow, I expect 520 level to hold, especially with the small caps rebounding and regional banks rebounding, and interest rates are pulling back from the overbought level. I think next week 520 should hold. Beyond May 31st, if you look at next week on June 3, 4, 7th, there's really not no large position. You would have to go into June expiration. And in June, we also have the next level. We don't really have much positioning um, at 520, very small. So the next positioning for June expiration is the 510 level. 510 level. So that's why 520 level is extremely important right now. I think if the market is unable to hold on to the 520 level, you could have a kind of a sharp pullback to 510. I still think that bulls will step in. John, welcome. Thank you for participating. I think the bulls will step in. John closing out trades. Thank you, Bob. Will gold and silver sell off, lowering of interest rates? That has been the correlation, right? It's kind of diverges periodically. Silver is overbought. Sometimes it rallies when interest rates are actually going higher. Sometimes it rallies when interest rates are going lower. Today, it's directly correlated, right? Interest rates are dropping, silver is dropping from overbought levels. So that PC data will definitely influence silver data. But so far, when the interest rates do drop, let's look at. We can see basically rally started in the beginning of May from silver, right? And if you look at the 10-year yield, it's kind of been all over the place, right? The yield dropped in May, right? And then it rebounded, right? So you can see that there's no really direct correlation, right? We had when interest rate dropped, silver rallied, and and in the middle of the May, we have a sharp rebound in interest rates, and silver is still trading kind of double top. So it could be where if the interest rates continue to drop, that silver will pull back. But for now, I wouldn't say it's direct. It's a direct relation. I think if the tomorrow short term silver is overbought, and if the interest rates do drop tomorrow, continue to drop tomorrow, I think silver will drop as well. But I don't think it's going to be kind of. I think 27 level looks very well supported, and 50-day moving average is at well supported at 26 level. Any other questions? Bob, John, Thomas, Steve, Fred, Lalit. John, Netflix trade. So let's look at Netflix trade. We do have market pullback. I've been trading Netflix. It did pull back together with the market, but you can still see, at least for now, as long as we're above 633 level, I think market Netflix continue to go higher. I mean, if you are doing day trading, today it's toward the session low, but I'm planning to hold on to the Netflix position as long as it's above 633, 635 level. If it does drop to 633, 635, which is the key support, then I would need to make a decision whether I want to be in this trade or not. In terms of, now let's look at Dell, right? So let's go through the Dell setup. So I think there's a lot of expectations for Dell. We've seen HPQ today up 20%. We've seen CRM today down 20%, right? So you can see that AI theme is very well intact, and it just depends, if you are able to deliver. And HPQ is up 17%. It hasn't been up 17%, I think, in the past 10 years, right? And CRM also kind of riding the wave of AI, but they guided lower, right? They guided lower, they missed the revenue, and the stock is down 20%. Also, two standard deviation moves in these some of the technology names. So I assume that Dell is going to make similar move. It could be 20 to 30% to the upside. It could be 20 to 30% to the downside. Last time, I think we rallied 30%, right? 30%. So large moves in Dell. So if you look at the earnings power trader, I'm sorry, I didn't do it in earnings power trader. Let's see, earnings power trader. We do have NTAP, we have Marvell announcing earnings. But not Nvidia. So let's switch to TradeSpoon. You can find all of the trades under TradeSpoon. Let me know if you guys have any questions. All right, John, welcome. So I did buy 205, 220, and 235 call spread, right? So, and I did get out of the HPQ. HPQ continued to trade higher, so it was a losing trade. I did close HPQ position, right? I did close HPQ position. So Dell, if you look at the open interest, right, high open interest on Dell, right, how people are positioning going into the earnings events on Dell, you can see that the highest positioning is around 200 strike, right? So you have a very large position around 200, spanning all the way from 200 to 220, right? Um, and so it's about $30 to $40 to the upside, right? So 20 to 25%, and to the downside, similar. You have largest position at around 150 strike, and then it does span all the way to 140, all the way to 140. So I think the stock could move to the upside, right, or it could move to the downside by these two standard deviations, similar to the way a CRM and HPQ move. So if you want to participate in this trade without spending, 2-3% of the money of underlying stock, right? 220. I was able to buy 205, 220, and 235 call spread for 90 cents. Why did I select 205? Because if you do look at the implied volatility move, so let's go back to Tradier. And we type in Dell. So looking at the implied volatility move, for May 31st option, right? So I would add straddle and strangle, right? So it's trading at 170 level. So let's go through that exercise together. So it's 1170, right? So I'm adding 1170, I'm adding 1140. Where the stock is trade, so it's $22 plus 1030 plus $1040. So two standard deviation move is $40, which is a little bit over 20%, right? 22%. One standard deviation market implies $20 move, which would be around 10 to 15%, right? So two standard deviation move will take you to 210 level, right? 170 plus 40 is 210. So I do want the options. I do want the stock to gravitate toward 220 strike, right? To 210, 220 strike. And if you look at the positioning, right? So the highest positioning is at 220. Let me see. Sorry, present. Okay, so screen is back. Thank you. Brad, John, Thomas, Michael, Steve, thank you for joining. So if, as you can tell, you can see the highest open interest is at 200 level, right? We have a large position at 200 level. And so ideally, I want the stock to move to 200 and not exceed too much further than 220, right? That's where the maximum gain is. I think it can gravitate toward 200, and ideally, I don't want it to get up outside of the 220 level. And the two standard deviation move is around 210, right? So in theory, the stock, if it does have a positive news, it will gravitate toward 200 or to 210 level. So that's the reason for the buying 205, 220, 235 call spreads. It's a $15 strike, so the maximum profit is $15 if it stays at 220 level, and I'm basically risking 80 cents. But Dell could miss the earnings, right? It could miss the earnings, so I'm gonna go and do the same thing on the put side. Let's leave. All right, so you guys can still see my screen, right? You can see my screen, you can hear me, that's great. Well-defined support, this might be a good earnings trade. Thank you. GPS, I mean, it's been very volatile. All of the retail data, has been volatile. So we've seen that the Abercrombie and Fitch is up. We see calls is down. So and GPS gap is usually also a volatile stock, right? We can look at the high open interest shortly, and I would also do butterfly, just to prevent. If you always have to make a decision: do you want to sell volatility or do you want to be long volatility? When you see a large open interest, right, negative, when you see that volatility skew is below 50, right, you see majority of the expirations are below 0.50. That means there's a high demand for either selling puts, which you can see here, where people are selling puts. It's negative VANA, not positive, and even bigger demand for long calls. So a lot of people, the highest position is people are buying 200 calls, right? With the idea that it can gravitate toward 200 to 10 level. So that's on the upside. On the downside, $40 would be around 130 strike. So let's take a look at the butterfly. We'll do the same thing. We'll do butterfly. All right, more and more people are joining. Thank you for joining, guys. So trade option. So let's see. Let's go back to Tradier. So we did the call butterfly. So the put butterfly 170 probably will gravitate toward 140 strike. So let's see. So if I'm gonna sell, that would imply $30 move from 170 to 140. Sell. Let's see. I can do 140. Let's do 150. We'll do $10 spread. Buy, sell. So buy 150, sell to 140, and buy 130. Okay. So this would be selling, right? I would sell 140 two times. I would buy 150 one time and sell 130, right? With the idea that it will trade in the range between 130 and 150, right? So looks like we do want to have a 150 strike as long, right? And we can sell two 140 and buy one 130. And how much is this cost? It's about $1.20. $1.20. Let's see if we can do $15 strikes. So maybe it'll be more expensive if it's two. Let's see. You could do smaller strike price, smaller difference than $10. Probably don't want to do it, or continue to go maybe a little bit lower, right? I can do maybe 145, 135, and 125, right? So I'm buying 145, selling two 135, buying one 125, and I'm paying 65 cents, right? So 65 cents on the $200 stock is about 30, 40 basis points. So I think that's the spread I'm going to do. And 145 put is close to the highest strike price, right? This 150, right? 150 is where I think the stock could gravitate. So let's put on this trade. Dell, butterfly. So we'll do $10 strike difference in this case, since less demand for puts than there are calls. And what do we say? 145, 135. $145, $135, $145, $135, and $125. Strike 80 cents. Trading at 80 cents. Let's see. A limit of 80 cents. Right, let's see if I can get filled. Let's just double check. So I'm buying puts in case it does sell off close to 20%, 170 to 145. It's about $20, 15%. So buying 145, selling 135, and buying 125 put. And let's see if that works. All right, so it didn't get filled. Let's see if I can sell. $0.85 maybe. Okay. So at this point, I bought the call butterfly, which is, since the demand is higher, you get better, more premium for these options. So I was able to do $15 spread, 205 to 20 to 35, with the idea that I want the stock to reach 205, 210, close to 220 level, but not 235, because if I'm below 205, this would be a losing trade, right? Let's just recap. Sorry about that. Let's see, present. All right, sorry about that. We lost connection, but now we should be back. All right. Um, any questions? All right, so let's continue on now that we got our connection back. Um, let's look at the rest of the positions. We have about another 15 minutes left. So in terms of positions, I have Amazon spread 175, 180 call spread. Again, market is June positions are important, right? There's after this Friday, there's only 3 weeks left, so you want to make sure that we do address the June position. So let's look at Amazon. So Spiders is at 522. Let's look at Amazon. So Amazon is dropping below 50-day moving average. I do have 175, 180 spread. It's still in the money. I guess we need to look at, but it is below 50-day moving average. So we do need to look at the PCE data tomorrow. I mean, if it does come in better than expected, you could have a reversal and market could rally. And if not, then I would just have to exit the position. So Amazon does look like it's been under pressure. We talked about Dell, FXI, and Goldman Sachs. Let's see. FXI is a stock, so I do have time to manage the stock. Looks like FXI is actually outperforming the market. Interest-sensitive sectors that were under pressure today are actually up. You have Europe is up 1%, metals and miners up 1%, China is flat. Small caps are up, regional banks are up. So it's not kind of a broad-based sell-off, but you do have a sell-off in the technology stocks that have been outperforming and sitting at the key support level. So for FXI, I'm holding Goldman Sachs is a stock, right? So I also have a little bit of time. Well, I have a lot of time because I don't have to be correct on the direction of the market. And you can see that Goldman Sachs outperformed the market. The idea that at some point interest rates will go lower, and one of the main beneficiaries are wealth management companies like Morgan Stanley, Goldman Sachs, that do a lot of participate in mergers, acquisitions, and IPO market. So that's Goldman Sachs. Any questions on Discord? All right. All right, let's continue on. So we talked about Goldman Sachs. We talked about HPQ. So Netflix, right? We talked about Netflix. Netflix also pulled back. Netflix did pull back, sitting, but it's still above the uptrend. So it's outperforming technology. It's outperforming spiders. So for now, I'm long Netflix. Um, silver. We talked about silver. Let's look at silver. Silver continues to outperform. You do have kind of this double top. It could be volatile, but I still think it's going to trade above this uptrend, above the 50-day moving average. I think this is just a short-term consolidation. Personally, I think I would be a buyer at 27, 26 levels on the silver. Any questions? Bob, John, Thomas, any questions on Dell, Netflix, silver? All right, let's keep going. Texas Instruments and Wells Fargo, right? So Wells Fargo, let's look at Wells Fargo. Did pull back yesterday along with the rest of the market. Um, it's sitting right at the 50-day moving average, still above the breakout level, right? You have this consolidation for a few months above 58. It's trading at 59. It's actually up today with the other interest sensitive sectors. So that's positive. So I'm still long Wells Fargo, but it's a June position, just like Amazon. I don't have a lot of time. So with PCE data, right, next week, let's see, what do we have next week? We do have unemployment data, right? We do have unemployment data. We have ISM services data, PMIs, US services PMI data, right? Different surveys. We already had services and manufacturing data that came in better than expected. This is just a different way to collect the data. And then we do have unemployment data, right? We do have unemployment data on Friday. So after this week, we only have 3 weeks left. So based on direction of the market, it might not be enough money. Bob, welcome back. GPS. So let's go over the GPS suggestion again. Let's look at the position and see if you want to be long or short. I mean, there's really no pattern in terms of retail earnings. Some like Abercrombie and Fitch, right, had a very strong rally after the earnings. Right, we had Dick's Sporting Goods, a very strong rally, and then you have companies like Kohl's, actually pretty weak, right, down 23%. So GPS, Gap, I mean, they are going through restructuring. It's not like Abercrombie and Fitch. Going into the event, the chart pattern is, I would say, weak, right? We had a strong earnings last time, strong rebound. We went from 20 to 28, and then elevator up, elevator down, 22. In terms of, do you want to be long or short volatility? Let's look at the positioning. All right. So largest position is at 30, right? Implying $8, right? So that could be, what is it? 30% move. Right. So 30 is about 30% move. And gap could be volatile, right? We've seen the gap very volatile. So it could move. Largest position, I would say it's strike 30, $8 to the upside. And I would say 14, right? You have this large position around 16 strike. Let's look at what the implied value. This is positioning, how people are positioned into gap data, gap announcement. Let's go back to chain. 22 strike. Let's look at the 22 strike. So you have $1.40 plus $1.70. That's $3.10, right? Plus $4.10, plus another $1.50. So let's see, 3 plus 3. So it's about $6. So implied volatility, two standard deviation would be $6. So market in thinks that it could move roughly 30% to the upside, 30% to the downside. Based on Abercrombie and Fitch and calls, I would personally not be surprised to see a 30% move. Uh, Probably haven't had that for a while. Let's see how big was this move. 30%. Okay, so in November of 23, we did have a 30% move in gap. So personally, based on the positioning and seeing that you do have some shorts, long call buying. You have Vanna, negative Vanna. So negative Vanna implies that people are buying calls and selling puts. I mean, it's a calendar spread, so it's not like everybody's doing long and short, right? Um, but in July, right, in July expiration and in June expiration, you do have very large positioning, both at 30 strike and 20 strike. So if there is any negative or positive surprises, you could have basically $6 or $6 to $8 move to the upside or to the downside. Right? So personally, when I do see these spikes in negative Vanna, you want to be long volatility. So I would do similar to Dell or Nvidia being long volatility. You can do debit spread, that's more expensive. You can do calendars. I mean, calendars also a lot more expensive. Um, but the cheapest way to do the trade is the butterfly, right? If you do if you do condor, right, you can do, let's say, call condor. Right, then then your profit and loss looks like this. Basically, you don't have to be correct on the middle strike, but you do have to be correct on short strike. It's still a combination of a debit spread, right? This is a debit call spread, and this is a credit call spread. So whether it's a butterfly or a condor, you're doing a combination of debit spread and credit spread. Is just in butterfly, the shorts the short call is the same strike. In the condor, it's different, but then the condors will cost you a little bit more, right? It will cost you a little bit more. So just look, depending again on this relationship of probability of success versus return on capital, right? If you want higher probability of success, your return on capital will be a little bit smaller, right? And vice versa, right? So that would be the explanation for the condor. All right, Bob, John, Thomas, Michael, Steve, Lalit. Any other questions? All right, let's see the rest of the positions. So Wells Fargo, we talked about Wells Fargo, I believe. Let's just take another look at Wells Fargo. So Wells Fargo is sitting at the 50-day moving average today. I mean, you have a sharp pullback, kind of reversal, right? Yesterday, value stocks were underperforming. Today, they're rebounding. So basically, it's a good sign that we might be approaching the bottom in this pullback, right? And majority of the sell-off is in technology. So let's take a look at Texas Instrument. So again, Texas Instrument has been outperforming the market, semiconductors in general at all-time highs. We did have a sharp reversal in Texas Instrument, but it looks like it's trying to find a support and actually up on the down day, right? So that's positive, right? Semis are down 1.5%, and Texas Instruments, at least as of right now, are still up. I would keep an eye on the high yield as well, right? The differential between triple A bonds or treasury bonds versus the junk bonds, right? The differential is also driving the market. And we've been trading below 50-day moving average, kind of fighting for the 50-day moving average. High yield is up today, so that's positive. A lot of conversations about carry trade in Japanese yen. We did have a pretty sharp volatility recently in Japanese yen. There was an intervention by the Bank of Japan. It stabilized, but only for a few days, and now doesn't seem like it's working. Double bottom. That carry trade is also could impact the pressure on interest rates. All right. Any questions? I mean, Bob straddle. I mean, you could do a straddle, 22.50 straddle, move to $3 to break even. But with a $22 stock, right? If you're risking $3, that's more than 10%, right? So it's totally fine, but it has to move a lot, right? And you are risking basically more than 15% of the underlying stock. So that is a strategy. But if it doesn't move, right? If it doesn't move 15% up or down, then this would be a losing trade. An example of Dell, I would be down 75 basis points, right? So 75 basis points versus 10% of underlying stock. So it just depends, on your portfolio size, right? My goal is average account is $10,000. So on the $10,000 account, I don't want to risk more than 2.5%, which is $250. In example of Dell, I'm risking less than 2.5%, right? Close to 1% if you have $10,000 account. But in the case, if you do gap and you do straddle and you're risking $3, well, A, it's a 10% of underlying stock. B, 100 shares, you would be down $300. So just something to consider. I don't think there's a right or straddles are very kind of popular strategies, well documented. And I know a lot of people do them as well. All right, guys, it's 2:58. That's all I have for today. You guys been great, and I will see you tomorrow at the closing bell. Thank you very much, and have a great day.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.